Hello and welcome back to Explain the Charts. Today is October 21st, 2025, and we are taking an in-depth look at the QQQ, the ETF that tracks the Nasdaq 100. The market is at a fascinating and critical juncture, retesting its all-time highs after a very volatile couple of weeks. In this video, we'll first break down the recent news and economic events shaping market sentiment. Then, we will dive deep into the daily, hourly, and 15-minute charts to see what the price action is telling us. Let's get started by looking at the broader picture on the daily chart. First, let's talk about the news driving the narrative. Over the past week, reports from outlets like the Economic Times and MarketWatch show the market has been advancing despite some underlying concerns. A major tailwind has been persistent optimism around artificial intelligence, with strong earnings and growth from key players like NVIDIA and other semiconductor companies lifting the entire tech sector. This has been reinforced by Q3 earnings forecasts, where the Magnificent Seven mega caps are expected to post impressive 14.9% year-over-year earnings growth. Geopolitically, investors were encouraged by remarks from President Trump suggesting a de-escalation of trade tensions with China, which helped the market log weekly gains last week. However, it hasn't been a straight line up, as Yahoo Finance noted a snap in winning streaks earlier in October, reminding us that volatility is still present. This mix of strong fundamental optimism combined with geopolitical uncertainty has created the powerful push-pull we're seeing in the price action. Now, let's connect this to the daily chart. As you can see, the QQQ has been in a powerful uptrend for most of the year, recovering strongly from a major dip we saw back in the spring. After peaking in late February, the market experienced a severe correction through March and into early April, dropping from around 540 down to the 400 level. This was a significant pullback, but the recovery that followed was even more dramatic. Let's zoom in on that period to see exactly how that reversal played out. Focusing on March through May, you can see the intense selling pressure culminating in early April. Look at the massive volume on those down days, indicating panic and capitulation. But then, on April 9th, we see an enormous green candle with the highest volume of the entire year. This was a classic capitulation bottom and a powerful reversal signal, where buyers stepped in with immense force, completely overwhelming the sellers. That day marked the low for the year and kicked off the sustained rally that has taken us to the all-time highs we are testing today. Returning to the full daily chart, let's analyze the most recent action. After a steady climb, the market hit a new all-time high around 613 on October 10th. However, look at that candle for October 10th. It's a massive bearish reversal. The price shot up to a new record and then was slammed back down, closing over 3.5% lower on exceptionally high volume. This is a major warning sign and often signals a market top, as it shows sellers aggressively defending that new high. But, in a sign of incredible strength, buyers have stepped right back in. Over the last week, the market has erased that entire drop and as of yesterday, October 20th, closed right back near that 611.50 level, challenging the high once again. To get a better sense of this recent battle, let's switch to the 1-hour chart. Here we can see the anatomy of that drop and recovery with more clarity. The plunge from 613 down to the 590 area on October 10th was violent and swift. Since that low, however, the price has been grinding its way back up, forming a clear pattern of higher lows and higher highs. This constitutes a healthy short-term uptrend. The 600 level acted as a key psychological battleground, with the price chopping around it before finally breaking higher with conviction on October 20th. This recent action is undoubtedly bullish in the short term, but notice the volume on this ascent. While solid, it hasn't matched the intensity we saw during the sell-off, which could suggest this recovery rally has less conviction than the prior bearish move. Now let's drill down even further to the 15-minute chart to look at the momentum from yesterday's session. On October 20th, the market gapped up and maintained its upward trajectory throughout the day. We can see a clear and steady climb from the 607 open to the highs above 612 in the evening. The price action shows a constructive consolidation near the highs into the close, which suggests buyers are still in control. This strong close sets the stage for a test of the all-time high resistance today. Short-term traders will be watching yesterday's high around 612.80 as the immediate level to break for continued upside momentum. So, let's put it all together and go back to our daily chart one last time. We are at a critical inflection point with a bullish short-term trend running directly into major long-term resistance. Let's recap the key price levels you need to be watching. The most critical resistance is the all-time high around 613. A firm break and close above this level on strong volume would be extremely bullish, opening the door to price discovery. To the downside, the first area of support is the psychological 600 level, followed by the more critical support at the October 10th low, right around 589. A break below 589 would invalidate the recent recovery and confirm the bearish reversal from the all-time high. Longer-term support sits at the September lows around 560. So, what's more likely to happen next? The bullish scenario, which I would give a 65% probability, is that the market's incredible resilience and the positive news backdrop on AI and earnings will power it through the 613 resistance. Watch for a high-volume breakout and for the price to hold above that level on any retest. This scenario would be reinforced by strong earnings reports from big tech in the coming days. The bearish scenario, with a 35% probability, is that the market fails at this 613 resistance, forming a dreaded double-top pattern. The huge volume on the initial rejection is a serious concern. A catalyst for this could be a major earnings miss or a negative geopolitical development. A break below 600 and especially 589 would be the confirmation for this bearish case. The key thing to watch will be volume. A breakout on low volume is more likely to fail, while a rejection on high volume would add weight to the bearish case. In summary, the QQQ is at a make or break level. The bulls have the short-term momentum, but the bears have a very significant reversal candle at a major resistance level to lean on. Thank you for joining me on Explain the Charts. If you found this analysis helpful, please hit the like button and subscribe for more in-depth chart breakdowns. And as always, remember that this video is for informational purposes only and is not financial advice. You should always conduct your own research and consult with a financial professional before making any investment decisions. Trade safe, and we'll see you in the next video.